the bigger picture is much scarier than that. So I think we might have a recession coming. And as investors, we have to figure out what to do about that. And I think that the Fed going back to easing again is the way the markets responded today. It's good for gold and silver. And with the amount of money that's in the world right now, the amount of credit that's out there, the amount of bad debt that's out there, precious metals are a very attractive conceptual investment. And the Fed cutting interest rates just gives an extra excuse to anybody who wants to load up on precious metals. So, I think that's the picture from the standpoint of gold bugs and stackers, is that we're heading in the right direction for the next leg of the bull market.
John Rubino, in a recent analysis, posits that the current financial system is beyond repair, prompting a potential rise in precious metal prices. In uncertain economic times, investors typically turn to gold and silver as safe havens. The anticipation of such a trend reflects a growing consensus that the system's fundamental issues are insurmountable. Post the upcoming election, if financial policies remain unchanged, a larger segment of the population is expected to abandon efforts to fix the system and instead seek refuge in alternative investments. The Federal Reserve's potential decision to cut interest rates is seen as an attempt to mitigate an imminent recession. However, Rubino emphasizes that no interest rate adjustment can salvage the fiat currency system or fractional reserve banking. With the substantial amounts of bad debt and credit in the market, easing interest rates may further drive investors towards precious metals, reinforcing their status as a preferred asset during economic instability. Indicators of a looming recession are numerous and alarming. Default rates on commercial real estate loans are rising, and housing affordability is declining, signaling trouble ahead. Home sales have plummeted, and an increasing inventory of unsold homes suggests that prices may soon fall. This housing market distress could trigger a more widespread economic downturn as falling property values impact financial stability across various sectors. Make sure you hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our recaps. Also, check our description for full credit details if you want to watch the whole interviews. Enjoy the episode.
Well, all economists and financial analysts have indicators that they like, which they believe have some kind of predictive value. And there's dozens of indicators out there, and everybody has their own favorite set. But right now, there's a gigantic number and a growing number of indicators that are pointing towards a recession. Now, the way this works, an indicator is some kind of financial data series, and you can graph it, and you see what it did before the recession of the 1980s and the recession of the 1990s. And if it does the same thing over and over again, and a recession ensues, then it's got predictive value. There are tons of stats out there today that are all pointing in that direction. They're all doing that thing that they did before the 1990s dot-com bubble burst or before the housing bubble burst in the 2000s. So you really got a nice choice of indicators all pointing in the same direction. And, the jobs market is one in the US where it's not nearly as healthy as it seems. And we're starting to lose full-time jobs, which you wouldn't be doing in an expansion. And all the real estate indicators now are pretty much terrifying. You look at commercial real estate, where the default rates on big office buildings are rising, and the occupancy rates on office buildings are falling, and defaults and delinquencies are spreading to things like apartment buildings, things like that. Well, if a lot of big pieces of real estate are going to be sold at losses in the coming year, which is what it means when there are defaults and falling occupancy rates, then somebody's got to take the losses, and it's going to be the banks. And the banks are then going to have to report losses on their own earnings statements, which will scare depositors away, which will cause the banks to have to sell even more depreciated real estate and other assets, and so on until you get a banking crisis. Well, the real estate indicators are all pointing towards something like that happening. And kind of same thing in housing, where you've got the average person no longer able to afford the average house. Housing affordability is a really reliable indicator. And when that happens, when people just can't afford to buy houses anymore, home sales dry up and home prices start to plunge. And we're seeing that now in housing where, home sales are just minuscule right now. There's a rising inventory of homes for sale, especially new homes for sale on the market. Prices have not yet come down, but as the inventory goes up, prices are going to have to start to fall in order to incent or to allow people to be able to buy houses again. So things like that. And, it goes on, but there are just so many indicators that all point in that same direction that we're going to have a serious slowdown next year. And it could turn into a recession that's potentially dangerous because there's so much bad debt out there. So that's when things get interesting. Not, that we're having a recession is just normal. A business cycle does that. But when there's so much financial fragility in the marketplace and the global economy, when a recession happens, you risk lots of other things blowing up besides the things that caused the recession in the first place, and that leading to something much more serious than a garden variety inflation. We faced that in 2008, 2009, where the housing bubble burst. And if we were a healthy society back then, a little housing bubble burst would have been no real big deal. But there were so many bad derivatives out there, for instance, and stocks were wildly overvalued. And it was just the kind of environment where one thing can start knocking down other dominoes, and you get something like the Great Recession or something much more serious than the Great Recession. Well, we're back there again in that same place where there are all kinds of things that could go wrong and could just wipe out different sectors of the economy. And they're all kind of ready to happen. So we're looking for the catalyst, the one thing that starts the ball rolling. And then we see what the Fed does, and I suspect they'll panic on the monetary easing side when this starts happening because they see all these bad indicators out there and all these imbalanced industries that are kind of ready to go. So I think we'll see the recession happen, and then it gets interesting because the Fed's response will probably be what in normal times would seem overblown, but it'll be very big because they see the risks that are out there.
In today's news recap, gold and silver's high price recession. So China didn't buy any gold for its central bank reserves for the second month running in June, writes Adrian Ash at Bullion Vault. Chinese consumers have meanwhile vanished from the country's jewelry stores, and Indian households have also quit buying. Silver-backed ETF investment funds have grown less than 5% in size from last month's 4-year low, while gold ETFs ended June at their smallest mid-year size since 2019. After making out like bandits in 2021-22, retail gold investment dealers and mints are really struggling as high prices combine with high interest rates to crush Western demand for coins and small bars. The world's bullion markets this spring set new all-time gold price highs day after day and came within 1 cent of $2,450, while silver topped $3,250 for the first time since 2012, adding almost 45% in U.S. dollar terms inside 11 weeks of silver trading. Yes, that surge has burnt itself out. But silver ended last week with its highest Friday finish in London since the 11-year high it set in late May, down only 2.2% from that Friday's weekend peak. Gold, meanwhile, recorded its 5th highest ever Friday for U.S. and Euro investors. Even the British pound's clear relief at Labour winning a landslide UK election victory over the Conservatives still gave gold its 6th best weekend in history against sterling. Now we'll show you more clips of the latest interview, but first, smash the subscribe button, turn on notifications so you do not miss out our daily recaps.
Home prices go up until they become unaffordable. And then they have to go back down because by definition, if nobody can afford a house, prices have to fall to allow them to afford houses. And we're kind of right at the end of that process right now. Home prices have been going up. Actually, we still think of the 2000s as the housing bubble decade, but house prices have actually gone up more in the last few years than they did between like 2004 and 2007. So we're back in that place again. Only this time, there are some new players with massive amounts of houses on their balance sheets that are likely to panic. And so that's why when you see home prices going up and inventories going up, but sales not rising to match those other numbers, you get kind of what we have today, where people can't buy houses, but there are still cash buyers like Wall Street hedge funds in the market pushing up prices, but it can't go on for much longer. And in housing in particular, you got these new players coming in. One is the Airbnb industry, which really barely existed back in 2007. But now, in the last few years, times have been so good in the housing market because interest rates have been so low that you see a lot of people having built up little empires by buying 17 houses or 25 apartment units or whatever. And things are no longer working out for these guys the way they hoped that they would. It's just not that profitable a business now. And that's leading to a lot of them. And interest rates are up. So to the extent that they have to refinance their properties, they have to do it at a higher rate. So they're making less money. Their interest costs are rising. And a lot of them are looking at cash crunch, leading to a default, leading to bankruptcy. So you're going to see a lot of those guys start dumping inventory going forward. That's almost a given. And then all the private equity companies and hedge fund companies that have been buying up whole neighborhoods for cash and then converting them to rentals, when prices start to roll over, that'll pull rents down, and that's going to make their business model a lot less tenable. And they've got huge inventory. And what Wall Street normally does is they pile in towards the end of a bubble. And then the guys that got in last have to start selling because when the bubble bursts, they go bankrupt first. We'll see that again with the private equity landlords out there. So potentially what we're going to see is housing roll over and then all this inventory just pour into the market, leading to a big decline in home prices. Okay. And, very hard times in the home building industry and the ancillary industries that feed the home builders, lumber companies, factory or furniture makers, people like that. So you get the potential for a pretty serious recession just from a housing bust. But we've got all kinds of other things going on right now. So the everything bubble is not going to be just one bubble. It's going to be a bunch bursting either sequentially or all at once. We'll have to see. But we've created the conditions for that to happen in the next year or two. So, and again, the Fed is aware of this. They see the potential for a lot of things to roll over, causing very big crises out there. And they really want to start easing to try and head that off. And that's where they are right now. So they'll take whatever excuse they can legitimately hide behind to start easing. It might be September, it might be after that. We can't know that, but it's very possible. Money than they really should in order to manage all the bad debts that are out there already. Everybody's life gets harder. In the US, let's just take a couple of examples. The average person was not much more than getting by in 2019. You had a handful of very rich people in the US and a shrinking but still existing middle class. And then you had a whole lot of people, maybe the bottom 50% of the economic ladder, kind of sort of able to put food on the table and feed their kids and drive to work. But then in 2020 to 2023, inflation, because we created too much new currency and generally screwed up the financial system, that raised the cost of living for those people in the 50% by 30%. And it left them with maybe not the ability to do all three things that they've got to do, put a roof over their head, feed their kids, and drive to work.
What do you think of today's episode? Do you agree with John Rubino and his forecast of a major recession in 2025? Will gold shine while the dollar sinks? Is gold and silver the only way to be protected against a major banking collapse? Post in the comments section down below your honest opinion. Share this video with a gold bug and check this video right here because you'll love it. I see you on the other side.